Hello, friends. Thank you for joining us this Masters Thursday on a dreary November afternoon here in Charlotte, North Carolina, and thanks for tuning in to us instead of everything else that may be going on in the world. I expect a very robust conversation and deep dive on data here on fund finance as we take a look at the numbers in 2020, a year that's been unlike any other. I'm Wes Misson. I am a partner here in fund finance with our global practice. It's important to note that, though, that this panel is only going to cover data from the US side of our practice. And I'm joined by a couple of my esteemed colleagues, Tim Hicks and Holly Loftus. I will actually flip it over to them so they can say a little bit about themselves. Tim?
Hey, yes, thanks, Wes. My name's Tim Hicks. I too am a partner alongside Wes in Charlotte with a sole focus on fund finance.
Good afternoon, everyone. Welcome and thank you guys for tuning in to our panel. My name is Holly Loftus and I'm counsel here at Cadwalader. I've been a practicing attorney in the fund finance space for a little over 10 years, largely focusing on representing lenders in this space. Again, welcome, and I'll send it back over to Wes to get us started.
Thanks, Tim. Thanks, Holly. So this panel has really become a tradition unlike any other. And as I've said, 2020 has been a year unlike any other. This is a process, that I would like to call what, the Moneyball effect of fund finance. And so Tim will know what I'm talking about as a baseball guy. Really a project we undertook about 4 or 5 years ago where we said, okay, let's go and let's pull all this data that we've got. Because we feel like at Cadwalader, we've got a very good cross section of the market, having done so many deals. Now we're in the thousands of deals over the years, to really start taking some of that data and being able to take a look at trends that are going on and then extrapolate it and try to forecast out what's going to happen next in the market. And it's very helpful for us, and we're very pleased to be able to share that with you and make some of those projections today. And hopefully we can be even more accurate than some political polling. So with that, we'll go ahead and we'll jump right into it. Next slide, please. So taking a look at this slide, this is probably my favorite slide of the entire presentation because it really tells the story that we're trying to tell you today. And so if you look at this, you've got 3 columns. You've got 2018 data, you've got 2019 data, and then if you go to the far right, you're going to have what we've seen through 2020. And please note, this is not even through today. This is only through quarter end. So quarters 1, 2, and 3 of 2020 so far. And so you may start looking at some of these numbers and be in disbelief because you would have thought, given the disruptions we've had this year, given COVID, given work from home, given everything else that we've all had to go through together, that the market would be down, and that's simply not the case. And so, I think nothing tells that story more than just looking at the pure raw number of deals that we've been able to execute on this year. You look at that, you've got 333 deals done in the first 3 quarters of 20 compared to last year, 317 all of 2019, and a meager 191 in 2018. I mean, look at that growth year over year. And commitments, it's telling the same story. Commitments were actually slightly down last year from 2018. Boom, we're back up. We're $69 billion worth of commitments on deals closed this year in 2020. I think some interesting things to note, the numbers aren't all up, because if you look at number of banks that are participating in the market right now, number of banks we've represented, number of sponsors for deals we've closed, those numbers are actually slightly down. And that tells a little bit about the story too. Tim's going to get into some of the conundrum with fundraising and what's been going on there and how some of it could be down, but yet our market up. And so this really kind of tells a story about, some of the players having to take a step back, maybe hit the pause button, while others have stepped up and really kind of, swallowed up some of the demand that would have otherwise gone unserviced in the market. Taking a further look at these numbers, average deal size, that is up. I think it's very important to note, though, that that is not the case for pure new origination, new money deals. So these numbers are taking into account, just so you know, all extensions, all increases of facilities, as well as just brand new originations. And so new originations will tell a slightly different story on deal size. And our hours, definitely trending up. We're projecting 23% increase in hours by year end. We took on in the US alone, 5 new personnel on our side to help with that. And that turned out, although tough for some of these people to transition in, during COVID with work from home, it's been a blessing to be able to have, a super deep bench to execute on all these deals. So with that, we can move on to the next slide, please. Okay, so taking a look at the deal count, what I want to point out here in these bar charts, a couple of things. So look at Q1 2019, zero in on that. That's going to be your bar on the left on each of these graphs. And then take a look at Q1 for 2020 on the right. I mean, that tells the whole story right there. So what we saw was a massive, massive pull forward of transactions in Q1. This started to happen in March, and then even started to continue through. There was a little bit of a spillover effect in April, but mostly March, because COVID hit. There was a ton of uncertainty in the market. Pricing was going to move up. Terms were going to get tighter as credit standards were tightening. And so borrowers were saying, hey, we want to go ahead and get some certainty. We want to have liquidity, and we need to close this now. And banks were also saying that too. Like, look, we don't know if we can give you the same deal next week that we've offered you today. So let's go ahead and get this closed. And so what it meant for our market and our practice is, we were closing something like 30 deals a week the last couple of weeks of March. And we ended up with these eye-popping numbers of 80 deals closed in the first quarter, $12.7 billion in terms of lender commitments for the first quarter, which is the largest first quarter we've had on record. And then you see the effect of moving forward as the market started to normalize a little bit more. Q2, Q3, pretty much on par with where we were in 2019, kind of a normal quarter. So kind of that huge rush to get things done, that pop in Q1, and then starting to normalize the market. But the big overarching story here is how well the market has held up and performed despite all this volatility. We're on pace already having the largest year on record for both number of deals closed and commitments on the bank side. And so that's going to continue, and we're going to run those numbers up, and we're going to end up seeing the heftiest deal we've ever seen before. Next slide, please. So here's where I was talking about on the first slide when we were looking at the movement on deal size. And I was saying, look, don't get too hung up on, deal size going up on the overall numbers, because that included extensions and increases. This is where we look deeper into new originations. And so these were pure brand spanking new facilities, new money deals, not doing portfolio work on existing deals. And you can see the 151 billion to 158 billion, the size is down slightly. I think there are a couple of trends that we can note there. I mean, one, you had a lot of bilateral transactions with getting done, smaller commitment sizes because you weren't able to fill out a syndicate. And when you take a look at the last couple of years, 2018 was the year of record for the mega deals. And when I say a mega deal, I'm really talking about a transaction that was over $1 billion in lender commitments, and you were going to have it broadly syndicated with a number of banks. Last year, that number was down to 6, and there were almost no mega deals that were getting done in first quarter and early second quarter this year when COVID hit. Everything was getting pulled forward, being done on a bilateral basis. Even deals for large sponsors that normally would have been syndicated, we were closing bilateral first so we could kind of lock in terms and pricing. And then we were going to move and syndicate those later. And I will say part of this story is going to be a comeback of the syndicated transactions. Next slide, please. So taking a look here, this goes hand in hand with what we were talking about on bilateral versus syndicated deals. So the bilateral share was way up. I mean, first quarter, 11% of new deal count was syndicated, so 90% bilateral, right? And more than half of the bank commitments were coming on a bilateral basis. That's extremely odd for any quarter that we've seen over the last 3 years. And again, that was because banks needed to get these deals done Borrowers wanted certainty, and so it was almost impossible to get a mega deal done in March and April. But the good news is, I mean, take a look at the charts here on the screen, percentage of syndicated deals of new deal count this year versus last year through 3 quarters, and then based on new deal commitments, and it's almost even. And I think by the time we get to the end of this year in 2020, I mean, fourth quarter is looking stronger on syndicated deals. There was a huge comeback in Q3. I think we're going to end up right on par, if not up, in terms of syndications. And so that's an incredible comeback story. Next slide, please. And that's just kind of, highlighting the trends that we've seen, on the whole with the way deals have been moving. But now I want to turn it over to Tim and let Tim tell you a little bit about what's going on in the fundraising world and how that's influenced deal flow.
Yeah, thank you, Wes. I mean, I think the chart in front of you really would not come as a surprise to anyone. If you look at just simply the number of funds that were formed during the first 3 quarters, it's down in 2020. I think no one would be surprised by that number. I will say this is based on Preqin, and Preqin tends from time to time to update their numbers with a little bit of about a 6-month lag or so. So these numbers may move upward a little bit, but I think this is a fair representation of what 2020 has been from a fundraising perspective. So the interesting thing is, if you look at fund count being down, the number of new deals that we're actually doing this year has been up by 12%. At first glance, I thought that this was primarily a product of we were doing a whole lot of very small deals, and as a result, deal count was high, and we were matching sort of the offset of the decrease in number of funds that were being formed. As Wes showed you in a couple of slides previously, the numbers are down slightly in terms of fund size, but they're not so dramatically that would explain exactly what has happened. My belief is that facilities have become so commonplace, we're continuing to penetrate the market, and there's just more funds that are looking for facilities, and therefore, even with the dip in fundraising, the number of deals that are being done has increased. So next slide, please, if you don't mind. A very similar story here, commitments are down. So if you look at just the number of funds that are being formed, it makes sense that commitments would be down as well. But if you also look at the number of facilities and the commitments as it relates to the facilities, they're actually up. I think this is a product of a very clear trend. Those marquee private equity funds that have shown a track record of being sort of what we would perceive to be blue chips, they're attracting the investment dollars, and they're still getting facilities. I think they continue to be bankable, and I think that banks are still chasing their primary sponsors. So with them getting the new money that is raised, I think that explains why commitments are higher, even though on an overarching basis, commitments are down as a fund. So I think this too also shows that there are a lot of credit facilities that are out there. We continue to put more in place. I mean, that's present by the fact of the first slide that Wes showed you with the number of deals that we've done. I think that's very clear that subscription facilities have not slacked in terms of number. So again, tells the story of commitments, number of funds being down, but commitments and number of deals being done are actually up. So if you'll move to the next slide, please. This clearly illustrates what I mentioned earlier, that the market has simply moved to larger funds. If you look at the percentage of funds that are over 500 million or greater, that is the market. And in the last, from 2010 to 2015, those funds only comprised 83%, which is a huge number, but it's moved up dramatically in the last 5 years, such that 88% of the funds out there are $500 million in commitments or higher. So I think this clearly shows the trend that funds are getting larger, and that that has shown itself to be the case over really a 10-year period, with a few blips here and there, but for the most part, that has been the trend. You'll move to the next slide.
And Tim, is that really like a flight to quality trend that we're seeing there? And do you think that's as a result of COVID, or what do you think that is saying?
Well, I certainly think that it goes back to the fact that if a fund is able to raise money, and many of these funds have, during a pandemic, if you have X number of dollars to spend, you're going to chase the fund that you think presents the highest quality. So I think large investors, institutional investors that are looking to put money to work, they have relationships with certain marquee sponsors, and that is the quality that I think's moved the money. Yes.
Yeah, trust who you know in an uncertain time, and probably a lot of selectivity based on asset class too.
100%. I think during a pandemic, you look for certain assets that you're comfortable with. And in that setting, I think you go to names you know, people you know, and products you know. So this slide, I think, is kind of interesting, and it really ties in the data that we showed earlier in terms of, if you look at the vintage of the LPAs that have been the product of new facilities this year, 50% of those were LPAs that were 2020. So that shows that you're having your first fundraise, your first closing, and you're getting a facility in place quite quickly. By the same vein, if you look at the number of deals that were 2019 deals, it's still a large percentage. It was 26%. But it really goes back to the fact that the fourth quarter of 2019 was an incredible quarter for fundraising. So I think a lot of those deals were drugged forward into 2020 and were done in the first quarter of 2020. So technically they're a 2019 LPA, but they were closed really in the fourth quarter very quickly to really, you could almost lump them with the 2020 numbers. There's a few deals, obviously 18% and a 6% that are from prior years. I think those are largely refinancings that have come about because 3-year tenor deals, or for various reasons, it's time to sort of restructure a facility. So those older deals seem to be fewer and farther between, as opposed to new facilities, new money based on new fundraisings this year and the last part of last year. So on that, I'll turn it over to Holly. I think this is probably one of the more interesting, and I suspect a lot of people will zoom in because she is going to present what we have called our league tables based on the information that we've gathered this year.
Tim, I was just going to add one comment there. So it's kind of interesting, right? It's like an interesting weather year with wine on how that vintage is going to turn out. And so, it'll be interesting to see how the true 2020 fundraising vintage turns out for funds and what that means for our market going forward.
Well, we can certainly make projections and forecasts on what that would be. I think they're just that, they're forecast. And I think at the end, I'll give you kind of my views on what I think 2021 holds.
Thanks so much. Thanks, Wes. All right, next slide, please. Okay. All right, so now we're going to move into pricing. I know everyone is always really interested in these slides. So the slide on your screen, it shows subscription facility LIBOR-based margins dating back to 2018. Do note that this does not include pricing for prime rate loans. We're only looking at LIBOR loans for these purposes here. But if you look at the slide, you can see that leading up to COVID, the market had really settled in at about 150 basis points. And you can also see that during that time, institutions were actually trying to find reasons to price deals even lower than that. But of course, that all changed once you hit about March 31st of this year. And looking back, it makes sense. We know that New York's stay-at-home order went into effect on the evening of March 22nd. California had just issued their stay-at-home order around that same time. So there was a lot of uncertainty starting to set in. And obviously, you can see that the margins we've seen since March haven't really dipped below 150. And what we've observed since March, and this data bears out, is that the institutions seem to now be pricing deals on a case-by-case basis. Whether it's for a new deal or even deals that are up for renewal. We've seen a lot of new pricing come in with respect to transactions that are being renewed. Okay, next slide, please. And so just continuing our discussion with pricing, we've got a few more graphics to show you on this slide. The blue table reflects the high, low, and mean pricing Cadwalader saw in 2019. And then the table on the right provides the same information through Q3 of last year. You can see that the mean has increased by 11 points as compared to last year, but pricing as a whole has actually been in a tighter band this year. And we've sort of speculated on our end that, perhaps the types of deals that were previously getting done on the margins or on the fringe, just haven't gotten done this year as a result of the pandemic.
Yeah, this is very interesting to me, right? Because you see, as expected, the mean pricing going up, but the high is much lower than highs we saw from last year. And so what that tells me, right, is that you were seeing some less bespoke, less riskier transactions getting done that weren't pricing as high, because otherwise pricing should have gone up across the board.
Yeah, I think that's exactly right, Wes. All right, so let's move to the next slide. All right, so this slide breaks subscription facility margins down by quarter. You can see that in Q1, pricing was very clustered, just as we saw in 2019, not really anything surprising there. And then in the second quarter, after COVID hit, there was a much wider range, which you can see up there. And then finally in Q3, the average ticked up, but the band really started to narrow back down from what we saw was going on in Q2. And that concludes our pricing segment. I'll hand it back over to Wes for a discussion now about Tenor. Oh, sorry.
Thanks, Holly. Next slide, please. Okay, so look, this slide really tells the story about what we're seeing in terms of a huge shift in the market from longer term, long tenor deals to shorter tenor. And so if you look at what happened 2019, which is really consistent with prior years, you see, you still have a lot of deals 4 and 5 years. Those are really reserved for very large syndicated deals, large sponsors most times. And so since we've seen less of those done so far in 2020, the 5-year deal is almost non-existent. 4-year deals also way down. I mean, we're going to be about half, if not less, by the end of the year in terms of 4-year tenors. But look at that growth and that increase for 3-year tenors, right? So you got the 4 and the 5-year tenors moving to 3 effectively, and then everything's pretty much getting done as a 2-year deal right now, or you see 1 years as well. This actually works well for the borrowers, I would note, because in a market where firms were getting a little tighter, you've got a tightening of bank credit standards, a box of the types of deals that they can do that you've got to work within, and you've got pricing increasing. Being able to do a shorter deal and then have the ability to renegotiate for an extension or for the next deal, could be favorable. Although it has some transaction costs, obviously, of having to revisit the transaction. And then the other thing I would note is, we're starting to see a comeback on the syndicated transactions, Q3 in particular, and now going into Q4. And so I think by the end of the year, the story is going to start filling in a little more in the 4 and the 5-year. In fact, I've seen a term sheet this week for potential 5-year tenor transaction. Next slide, please. So here, flight to familiar. This is the story that started in March, really a back to basics story in the market. Let's get back to kind of the core, plain vanilla, right down the fairway, if you will, transactions in fund finance. And so what did that include? Okay, so that's going to be your bilateral deals, because it was easy to get done. You just had to have one bank get on board. It was going to be smaller. They could hold the entire thing, right? So you see bilaterals going up. Subscription deals. Okay, let's look at deals that are more inside that box, traditional subscription, a little less risky. They're not going to have a ton of hair on them. And then commingled fund borrowers, right? So let's not take a ton of single investor risk, or look at something that's super bespoke. Let's have more variety here in the collateral, and a more varied pool of investors that we're underwriting. And so you kind of get back to the basics of really what you saw more of in kind of the earlier days of subscription finance, really ruling the day in 2020. Next slide, please. And so same thing here on taking a look at the collateral and the commitments by collateral. If you kind of go all the way over to your far right column in both of these charts, so looking at deal count, 190 subscription deals closed. We're talking new originations here. Only 27 for NAVs and 4 for management fee facilities. So, huge slant here towards traditional capital call subscription facilities. NAV deals started the year strong. We had 13 closed in the first quarter, and then things got a little bit hairy with the market. And there's been a lot of talk and a lot of banks trying to get in and do those deals, and they're still getting done. I mean, look, we've had 11 lenders so far do those deals this year, amongst some varied asset classes with the funds. And so I think that is an area to watch going forward, which could start to pick back up as the market continues to normalize more. And there's a need for it too. And then looking at the collateral by commitments, same story as above, just a little bit different on the numbers here. But subscription, capital call facilities, we're talking, over 31 billion on new originations versus, less than 3 billion for non. Next slide, please. Okay, and then here, this tells the story, but we're talking about types of funds. So, really we're talking more subscription, but what types of funds are we financing? Who is our borrower, in other words? And so taking a look, this is get back to the basics with the commingled funds, a little less risky, 254 deals. That's 84% of, what we've seen across the book this year. That is up almost 20 percentage points over 2019. That's an incredible number when you think about it, because the market had been trending downward. I mean, last year we were at 2/3 subscription in the US, and that was down from 78% or so the year prior, and now we're all the way back up to 84%. SMAs, this is the other trend that I would take note of here, and I wrote about this on Fund Finance Friday a little bit earlier in the year, and I talked about how SMA facilities had been down, but I thought they were going to make a big comeback, and man, have I been right on that prediction so far. So we've already closed year to date more SMAs than we did all of last year, which is sort of unbelievable. But when you look at how that was done, it was really kind of the pent-up demand and the fact that they weren't getting done in Q1 and Q2, and we've closed 13 of them in the third quarter. And I believe we've already closed, 4 or 5 so far in the fourth quarter. And so this is going to be a record year for SMAs. And I think that's going to continue now as folks have started to get more comfortable with those structures. And then taking a look down, the other types of fund, nothing to really talk about here. I mean, this is all kind of flat or down in most cases from 2019, really as a result of the market kind of moving to the more familiar. And so it'll be interesting to see whether or not that trend holds or if we start going back to the kind of more normal numbers there. Next slide, please. Okay, so Tim, you want to talk a little bit about overcalls and how those are pricing and trends?
Yeah, Wes and Mike did a great article in Fund Finance Friday earlier this year that talked about the impact of overcall limitations and what they do for pricing. And I think there's this perception that if you have an overcall limitation, banks view that as more risk and they price it accordingly. If you look at the number of LPAs that we've reviewed that involve overcall limitations, that number has certainly trended upward in 2019 and 2020. We're above the average if you look at a 5-year rolling basis. So I think this is a product of the fact that many LPAs are for sophisticated funds that have thought about the issue and have included it in prior funds, and it's starting to roll forward. And then funds that previously didn't have an overcall limitation, based on some ILPA guidelines and other things that they're hearing in the market, they've kind of moved in that realm as well. So that is the trend, that overcall limitations are here, and I think they're growing. If you go to the next slide, just a very simple graph here to show the point that I made previously, that just because there's an overcall limitation doesn't mean that pricing is going to be adjusted upward because of it. Now, I think you can explain this on the basis that there is a flight to quality. And I think premier sponsors, blue chip sponsors, demand better pricing, and they're probably the most likely to have an overcall limitation in their LPA. So as a result of that, you've got demanding better pricing, skewing the numbers with frequency that it occurs. But in any event, I think it does prove the point, and I think it shows what we've previously kind of put in some academic, articles out there, is that overcall limitations don't drastically swing pricing as one would concede that they might. If you'll go to the next slide, shifting gears a little bit, this is really an intent, sort of a shout out to our foreign counterparts that are tuning in for just kind of see how many deals are getting done in what jurisdictions. And not surprising here, Delaware continues to be the prominent. If it's an onshore fund, I think that's where one would expect it to be domiciled. Cayman Islands is certainly second by a wide margin, but I think probably the biggest uptick or something to note is the trend towards Luxembourg. It's not huge numbers. It's up about 2.5%, I guess. But I would say if you did that on a 3-year rolling basis, Luxembourg was quite rare. 2016, 2020, I think Luxembourg has become a definite player in the market and a jurisdiction that people have now realized that there are certain things that they need to prepare for if they have a Luxembourg fund from a documentation standpoint. So on that basis, I'll give it
I
back.
was happy, Tim, to see Holly's home state of Texas break into the league tables for the first time here.
Well, I don't think Texas is going to overtake Delaware, but we'll see. If they do, I might have to think about moving to Texas because it's a pretty nice little state.
Yep. Thanks, guys. Appreciate the shout out, Wes. All right, next slide, please. Okay. So I'm going to spend just a little bit of time discussing our borrowers council and Cayman Counsel league tables, redacted, of course. I know this may interest some of you, but maybe not all of you. So we'll try to keep this one brief. But this slide contains, again, our redacted league table for borrowers council based on deal count. And as you can see, the top 3 borrower council firms accounting for 35% of the market share we see based on deal count. Beyond those 3 firms, the work is really spread out around a number of other large and medium-sized firms that we probably do about 4 to 6 deals with per year. But again, there's sort of some repeat players that just have really good fund formation groups and have the lion's share of work. All right, next slide, please. Okay, so we've also put together a slide for Cayman representation in terms of deal count. The slide is further divided into firms that do Cayman borrower side work and firms that do Cayman lender side work. On the borrower side, you can see that the top 2 firms really have the market share of the work there, and frankly have for some time. So I don't think that's really surprising to anyone. But on the lender side, it's much more spread around. And anecdotally, I can tell you we've seen a lot of new Cayman firms who are stepping up to the plate and coming into this space, wanting to do the lender side work.
Yeah, and I will, Holly, take a moment here just to comment that we really appreciate all the help we've gotten from our Cayman friends in 2020 in particular, more than any other year. Also a different kind of year for doing deals with Cayman transactions because of the Cayman private funds law and really kind of everything that had to go into that whole process with registering all the private funds. And I know that was a huge push. It all got done with the August 7th deadline. And I think it was the champagne bottles popping that could be heard all across the world on August the 8th after that was complete. I am still looking for my invite to the Caymans when it's safe to go down for that post-registration party.
Yeah, absolutely. August 8th was a happy day for many in this space, myself included. Well, so that concludes the Cayman league tables. I'll hand it back over to you, Wes, so you can discuss market trends.
Thanks, Holly. Next slide, please. So, what does all this mean? Trying to, sum it up. We've gone over some of the trends on the data and kind of how we've gotten there and where we could be going. And Tim will speak next about, where we are likely going. But look, I think, we're at a point where we had this, some of the lenders, hitting the pause button or kind of pumping the brakes a little bit. They were going to be less opportunistic for a while during COVID. You had tons of corporate borrowers, drawing down on their revolver to have liquidity. You had product caps and credit risk issues in place and more restraints being put on the supply side. Some of that started to ease a little bit. And so it'll be interesting to see if that continues and if we might get, back into some more bespoke transactions. And you saw that kind of huge, back to basics, get back to center field shift in the market with going back to commingled funds, subscription as the bread and butter. And so interesting to see that's where we are now, if that's going to hold. New entrants in the market. Look, non-bank lenders, that's kind of been the word of the day. In Europe, look, there's been kind of a huge push there and a shift in what's been going on the lender side. We haven't seen as much of that here in the US, although we're seeing some insurance companies come in, we're seeing some lending funds come into our space more, particularly for NAV and non-subscription deals, pref equity deals, seeing some higher cost of funds banks come in. So it'll be interesting to see how this all shakes out, how this impacts the competitiveness of the market, syndication prospects and the like. Risk mitigation and transfer solutions. Look, this was talked about, I think, a lot more earlier in the days of COVID, but we are still, in the middle innings, hopefully the later innings. So who knows what's going to happen before the game is complete here. But there are a lot of banks that are still looking to sell down and get rid of some exposure so they could take on new deals for particular clients or kind of expand a little more in the space. There was a lot of talk. Didn't see much of it happening, but certainly a lot of talk about the potential for looking in the first loss pieces with insurance providers in the space. So it'll be interesting to see if that continues, picks back up, or if it's just kind of put on the sidelines. Pricing, we talked about it. Holly went through the dynamics there and what's happened this year. Been the most interesting year ever. I mean, last year you could kind of blindfolded throw a dart and you'd hit the same number every time. This year that's ticked up quite a bit. I mean, average pricing is 30 bips or more, kind of above where it was last year, depending on the type of transaction. We think that's peaked. The market's kind of stabilized and kind of, it's normalizing as we go forward. And so it'll be interesting to see what happens there. Bespoke facilities and NAV facilities, unless, we're talking about, premier sponsor or extremely good investor pool or asset pool with no issues and you can liquidate, it's going to be hard to find a bank in most cases, although they are out there. And so if you look, you're going to find them. But I think that trend is going to shift a little more, and Tim can talk about that. But I think we may see getting less away from kind of the pure play subscription and more into the alternative products that we saw the last couple of years. And then the last one, employment. I mean, look, we're work from home environment. Everyone's doing more with less this year. And certainly that's true on the bank side. And so we've seen kind of less personnel movement across the market. And so loan growth is continuing, but employment has, for the most part, kind of stayed flat to down. Tim, you want to kind of talk about where we might be going here in the later innings?
Yeah, I mean, I think last year, Wes, when you and I did this presentation, if you move to the next slide, just for our speculations, but I think, Wes, when we did this last year, we had a similar slide of what we thought. And the elephant in the room that was not on there was a global pandemic. And in fact, even in February, when we had the Global Finance Conference in Miami, COVID was starting to appear, but there was no mention of that being a 2020 trend. And no one could have speculated that, but it certainly is the elephant in the room because it goes into 2020. And I think its impact, whether it be on business travel and the ability to get in front of clients, or whether it's just, continuing to work from home, as you mentioned, that is a huge part of kind of a forecast. And I don't know that anyone could make that forecast, but I do think there are a couple of things that seem like they're trends that are viable kind of forecasts. Is that there's going to be some difficulties, I think, with growth. I mean, given how the market has moved, continues to grow each year, at some point, I think you reach a critical mass where double-digit growth becomes a little bit of an unachievable number. We've said that for every year that we've done a panel similar to this, frankly, and we've outdone ourselves. But I'll continue with the trend of saying that growth will be harder to come by. I think in certain sectors, of course, energy right now, there's a lot of focus on the president and where that comes out. I think there's going to continue to be a lot of competition when it comes to pricing. I do think things are starting to normalize, as you mentioned, Wes, and the pricing implications are going to probably go back to a competitive market where if you're an incumbent, you're likely going to have the advantage when it comes to doing a deal in 2021. I think we've seen this over time and time again, that you trust what you know. And if you're the incumbent bank, you're certainly going to have your term sheet received. And I think incumbents continue to hold sort of the pole position when it comes to getting the next deal. I have heard the next one at every single conference for the last 5 years is that NAV is going to be a great opportunity for growth. I thought that was 2020's opportunity. I think the market disruption and the pandemic probably stifled that a little bit in the US, although it's been great in Europe. But I do think that 2021, with the optimistic view that things will normalize, that is a huge opportunity for growth next year as NAV facilities, because simply a lot of these deals that were done in 2015, 2014, and there were a lot, they're reaching a point where banks just don't want them to roll off their books. And so they've got to find a product to continue to deploy that capital. And I think NAV facilities seem like a likely opportunity for that. Levered and unlevered sleeves are showing up with more frequent, I would say, term sheets referencing, leverage at the investor level, employee funds, and things of the nature of that have become a huge trend. And I think those will continue to be a trend. The other thing that I think is a huge opportunity for a lot of people is high net worth aggregator vehicles. I mean, many banks have shied away from that in favor of institutional investors. But if a bank could get comfortable with a product based on high net worth aggregators, that is a largely untapped market that could be a huge opportunity for growth, where, as I mentioned in the first bullet point, it might be hard to come by. And the last, I think there has been a hiring freeze largely across the industry. I think the tax bills that are coming out do make payroll taxes a little bit more challenging, at least on paper, if those are implemented. So I think there will be some opportunity for growth and extensive hiring to the extent that they've been stifled during the current year. But I don't see anything that would lead me to believe that there's going to be contraction in that department. And I think 2021 is poised to be another great year. That's just my personal view, but I welcome any thoughts that you have, Wes or Holly, or any contradictions.
Yeah, well, thanks, Tim. I think we're about out of time. I mean, just a couple of quick things I wanted to add, and then I'll turn it over to Holly to close us out. And I know she's got a CLE code for those of you interested in CLE too. One thing I know, we've gotten a number of questions. We're not going to have time to answer them in this session, but anyone that wants to and has a question, always feel free to reach out to any of the three of us. Be more than happy to answer that for you. And we've gotten a lot of interest on the slides, just like we did last year with this presentation. I will say, kind of hold on. This is only Q1 to Q3 data for 2020. We're going to roll out an entire book at the end of the year once we have everything in, and we can kind of see if we were right on some of these predictions and if the trends might have shifted. So just kind of hold on for that. But thank you very much for joining us, Holly.
Yeah, no, likewise, thank you guys so much for attending our forum. We know it's obviously much better to have these things in person, as Pat said in his opening remarks. We really appreciate everyone taking the time out of your workday to watch us all from your house or your apartment. I note that if you are intending to receive CLE credit, can we get to the next slide, please, to get the code? Well, there it is. Okay, great. I'll go ahead. So it's up there. I'll go ahead and read it to you guys twice. It's 8RQX71. Again, it's 8RQX71. Again, thank you all very much. We really appreciate it. And as Wes mentioned, feel free to email any of the three of us with any questions, or if you guys would like to discuss anything. We always love to hear from everyone. Thank you, guys.
Thank you so much.